Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Short Verticals. And today we're going to be talking about planning and placing exit orders on a credit spread to manage potential profits or potential losses as they work out. And in any case, I think there's a lot that we're going to be covering today. We're going to be planning that credit spread. We're going to be walking through the logic of how a trader might plan for the back end of the trade and then put in actually example orders by the time we're done. So a lot to address. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names, even though I'm the one that's sort of filling in today. This isn't my typical webcast series, but I still see a lot of familiar names. Great to see so many of you here. Hello there, Kevin and Alfie, Marcus, Chris, JDLMI, Robert, Kevin, Will, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but be aware that you're invited to join us in the live stream if you'd like to be here. This webcast kicks off each Thursday at 2 Eastern Time. I also want to let everyone here in the live stream audience know that my very good friend James Boyd is hanging out in the chats there. James is going to be addressing any questions that I can't get to just during the natural flow of the presentation. Thanks for having my back there, James. James and I would also like to encourage you to follow your favorite presenters on social media. You can find James and me on X. You can find James there at James Boyd CS. You can find me on X at Cameron May CS. You can also now follow me on LinkedIn. So you just go to linkedin.com/in and then /Cameron May CS is my handle. That'll take you right to my profile and you can give me a follow there. But let's get into this discussion. And of course, as we do, credit spreads certainly carry risk. We need to be aware of that along with so many other approaches to trading and investing. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including a loss of principal. Short options can be assigned at any time up to expiration, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with that important information delivered, let's set an agenda for today's discussion. First thing that we're going to do is just take a look at what's going on with the markets. I noticed somebody here saying it's nice to see a nice little recovery day today. Yeah, what we're going to do is take a look at the markets through the eyes of a trader who might be planning to place a new trade maybe for next month's expiration. So then we're going to go plan an example credit spread trade based on what we see on that market context. And then, very importantly, we're going to plan for the back end of the trade. Some trades work, some trades don't. Maybe a trader ought to have a plan in place for the potential management of either of those potential outcomes. So we'll talk about taking potential profits or taking possible losses, circumstances under which those might be done, and we'll place an example order to put that sort of a plan into effect. So that's what we're going to be going through today. Should be a good discussion. I'm looking forward to it. So let's get right to the thinkorswim desktop trading software platform. And this is the paper money version of thinkorswim desktop. And again, let's put ourselves in the shoes of a trader looking to trade a credit spread, maybe looking out onto the near-term horizon. I'm going to be looking for a trade for the January 16th expiration. So an important question becomes, well, does it look like stocks are likely to be higher between now and that selected expiration, or are stocks more likely to be lower? Because if we're trading bullish strategies in bearish market conditions, it can be tough to do that effectively. On the other hand, if we're trading bearish strategies when the markets are persistently bullish, could also be an uphill battle. So let's say that our trader is looking what's been happening with the S&P 500, and maybe it's just their personal conviction that what we've seen so much of in the last 8 months, which is bullishness, is maybe it's likely to continue. Maybe they look at this chart and they see that we've run up in a continuing series of advances and retracements. We've run up to recent near-term peaks and we've pulled back and starting to recover again. So maybe our trader has the outlook as they're planning this trade for January 16th. Let's say they expect prices more likely to rise than to fall. Obviously, it's not a guarantee that's exactly what's going to happen, but we're going to be placing a bullish credit spread for today's example. All right. So when we're bullish with options, we can buy calls. That's bullish, but that would be a debit transaction. A trader might also sell puts. That's also bullish. That generates a credit. That's what this webcast series is all about. So we're going to place an example credit spread trade, and today's trade is going to be, the example trade is going to be on Amazon. Obviously, you might wonder, Cameron, how did you choose Amazon? Well, a number of things that might influence a trader's selection of a specific stock. Among those potential considerations, the liquidity of the stock. Illiquid stocks tend to have illiquid options. That can lead to pricing issues, wider spreads between the bid and the ask price, more difficult to get in, more difficult to get out. So liquidity can be a big concern. Price per share can be a concern because we are taking on rights and obligations when we're entering into options contracts. And a higher price stock has greater obligations. Now, another consideration might be what's happening with the chart. And look what's happening with Amazon recently. Amazon's been really running up, pulling back, running up, pulling back. But a technician might note that we bounced off a near-term low right around 210. That was right around where we had 210 as a support level back in August. We saw that same level in the middle of October, raced up dramatically, pulled back sharply, found a new low, didn't quite go down to 210. In this case, bumped right off about 215. Went up a little bit less dramatically, worked our way back down, and now we're popping up off of 220. So higher lows. For some traders, they might see that as a sign. Despite this really sharp run up that's probably spurred by this earnings announcement and the sharp retracement, still seeing higher lows. And along with so many other stocks out there today, we're seeing some bullishness even today, with the stock up about 2.3% at the moment. So let's say that our trader just sees 220 as a likely near-term support level or price floor. And I think what we're going to be doing today is placing an example trade based on an assumption that our stock is just going to stay above 220. That's an assumption. Obviously, assumptions can be proven wrong, giving maybe a potential change in price direction in the future between now and the 16th of January. But let's just say that our trader thinks that shares are likely to go up, or at least to stay above 220. So let's plan a credit spread trade that's positioned to benefit as long as our stock stays above that recent 220 level. All right. Now let's see. I saw some questions that came in here. Wild Goose says, is that a head and shoulders? Are you talking about this one right here? Maybe kind of a tilted head and shoulders? Shoulder here, head there, possible shoulder there, with a neckline right through here? Could be. Yeah, some traders will look for head and shoulders. Typically, we like to see a horizontal neckline. Sometimes, though, it might be ascending or descending. But right now, it's looking like, even if we saw that as a head and shoulders, a bit of a failure of a break of that neckline. Still continuation of an upward trend would be the typical interpretation of that. Even if that's the way we see things, of course, it's not a guarantee of continued bullishness. Oh, you were thinking about, okay, I got ahead of myself on the S&P 500. I don't mind going back and having a look. I think we'll have time to look at that. Let's go back to the S&P 500. So maybe the same scenario is here. Is this what you're talking about? Shoulder, head, shoulder, that one's kind of I don't really see much of a head and shoulders candidate here, because typically we see the shoulders at about the same level, the neckline at on a horizontal plane, and I don't really see that. Okay, but let's pop back here to our Amazon chart. And so here's going to be the plan for today's trade. We're going to sell the 220 puts And then how about we go $5 down? Now, I did a webcast just a couple of hours ago on debit spreads, and we planned to place a debit spread with a plan for managing profits and a plan for managing losses. That one might even be in the archives already. I haven't checked. You might go look at that after this webcast is over if you want to see that. That was in my long verticals and diagonals webcast series. But for this one, let's plan to maybe sell the 220 put and then buy a 215. We're going to go $5 lower. In our last example, we went $10 lower or $10 wide on our spread. Let's go to our trade tab. Here's Amazon. Let's make sure that we pop down to the 16th of January. And let's outline an example trade. So this is a short put spread, also known as a credit spread or a vertical spread, credit vertical spread. And for this one, let's look at maybe selling the 16th of January. Let's see, we said the 220 puts, and those look like they're trading between 365 and 370. Let's say we're able to sell those for 365. Okay. And at the same time, to complete the vertical spread, we're going to buy a lower strike price, a less expensive strike price. We're going to buy the 16th of January. Let's get the strikes in here. 16th of January, 220 put. And let's say we buy the 215 put here. That looks like it might be between 239 and 243. Let's just use a round number. Let's say that it costs us 240. Okay, so those are the elements of our trade. Let's talk about what this accomplishes for us. Let's talk about how it may work out, how it may not work out, and how a trader might have a plan for either of those scenarios. So when we are selling the 220 put, we're collecting $3.65, but in exchange, we're making contractual promise to someone else. Someone else for the next 29 days or through the 16th of January is going to have the right to sell shares to us or to this trader for $220 per share. Now, if that were the only thing we did, we'd have a problem. Problem is, we might have to buy shares at 220 and we don't know how much we can sell those for. Well, that is the purpose of this second put. By buying the 215 put for $2.40, we now have the contractual right to sell shares if we are assigned those shares, and if we don't want to keep those shares, we now have the contractual right to sell those shares to someone else for $215. So if we get stuck with them at $220, we can unload those for $215 according to the terms of that long contract, and it limits the downside risk theoretically of this trade to $5. So let's talk about reward and risk scenario on this. How much is the maximum, the theoretical, let's talk about the theoretical maximum gain here. Well, the most we can make here is the net amount collected theoretically. So we're collecting 365 and spending 240. So that leaves us with a net credit estimated at this point of $1.25, not £1.25, but $1.25. Net credit between credit received minus the premium spent. So that becomes our maximum gain. What's the theoretical maximum loss? Well, we know we might get stuck with the shares for $220. And if we sell those for $215, that would be a $5 per share loss. But we did get $1.25 to set this deal up, even if it doesn't work out. And we can use that to sort of mitigate some of the loss there, but it still leaves us exposure of $3.75. So those are sort of the mathematical, they'll be facts if we're able to fill this order. All right, but theoretically, this is how much we can make. Theoretically, this is how much we could lose on this trade. It is one of those trades, yes, where there's more that can be lost than can be gained. Why is that? Well, because there's a higher probability of success than failure. And when trading spreads, there's a teeter-totter effect. When the probability of success goes up, the reward for being successful goes down, and vice versa. So in this case, we're exchanging a high probability of success for greater exposure to risk. That's the way it goes. Okay. Jeff says, so I learned that open interest on the call can be considered a call wall, and the put side makes the support. Jeff, I'd have to see what someone else had to say about that. I don't quite follow the logic there. I kind of get some of the implications, but I haven't been exposed to every possible turn of phrase in this universe, so that's just kind of new to me. Maybe somebody getting a little bit inventive with their phrasing. That's okay. I can relate to that. But in any case, let's talk about how a trader might manage this trade, as maybe we move toward profit, maybe we move toward loss. What are the circumstances that might lead to that? So let's say we put that trade on and we're thinking the stock is going to go up. Well, it might go up. It may choose to go sideways. It might choose to go down. Now, in each of those three scenarios, this trade could still work out just fine. So if we're above our two strikes, let's get rid of this one. Let's kind of clean things up. Let's remove this drawing. Let's actually move the start of this drawing to today. So today's the 18th. Let's push this one over here. There we go. So what this is now sort of visually illustrating is we're thinking of selling the 220 put and buying the 215. So what we'd like to do is see the stock stay up here. Let's draw a box here. That green box, this is where we would like the stock to land as we move toward our expiration. And in each of these three scenarios, we land inside that box. That's above our vertical spread. If we're up here, if we're at 222 or 227 or 237 or wherever above 220, if someone has the right to sell us shares for 220, but the shares are worth more than that on the open market, there's little motivation for them to do that. So they probably say, Cameron, I don't want to sell you these shares. They're worth too much to me. So they hang on to their shares. The contract just expires worthless and awesome. We just pocketed a realized gain of $3.65 on that put we sold. This is what we're looking for, is for these contracts to just expire worthless. Now, at the same time, we have the right to sell shares to someone else for $2.15. And if those shares are worth more than that, we don't really have motivation to do that, and that contract just expires worthless. So we lose the $2.40. Realized gain on $3.65, realized loss on $2.40, net maximum gain of $1.25. There we go. Now, if the stock collapses, I don't want to draw another box right here. Let's remove that drawing. And let's switch this for a trend line. Let me propose this scenario. What if our stock collapses in price from here? That can happen. Between now and January 16th, if the stock falls, it's not doing what we hoped it would do. As a matter of fact, it's falling into what we would, this is what I might call the no-fly zone. This is the no-go zone. Let's make that red. There we go. This is where we do not want to go, because if we're down here, what happens? Someone has the right to sell us shares for now more than they're worth. Are they going to do it? Yeah, very rare exceptions. They're going to do that. They sell us those shares for $2.20 and we think, oh, I don't want these shares. So we sell those according to our contract, allows us to sell those for $2.15. We just took a $5 loss on the stock, for which the $1.25 is small consolation. It leaves us with a net of $3.75 loss. Yep, Cecil, that is the maximum loss scenario. It's also certainly possible we might wind up in between. Let's do this. Let's activate this drawing. What about if we go down here? Well, it's still not working out optimally. We're below 220. We want to be up here. If we're at, let's say, 217 at expiration, someone has the right to sell us shares at 220. Are they going to do it? Probably not. They just walk away. We have the right to sell shares for 215. Pardon me. They do sell us the shares for 220. And we wind up buying those shares. They put those shares to us. Now, do we just turn around and sell those shares for 215? No, they're worth 217. So we allow that contract to expire worthless, and we wind up owning shares that we didn't intend to purchase. That's a possible outcome of this trade. All right. So if we're in between the strikes, be aware, or in any circumstance, if we're assigned the contracts while above 215, we may wind up owning the shares that we didn't intend to. So how might we plan to take profits if they emerge, to cut losses if they start to accrue? Well, if you were here in my webcast just a couple of hours ago, we talked about how traders might determine some percentages that they might settle for. Here's what I'm talking about. This is a trade where we have more to lose than we stand to gain. So a trader might want to, this is fairly common, the trader might be trying to optimize the amount gained. Try not to cut this off is the concept there. At least not cut it off too much. They may, on the other hand, try to minimize the amount of losses that are allowed to accrue. So here's one example. Let's say that our trader recognizes, well, I could make, if this trade goes optimally well, $1.25, and that could take the next 29 days through the 16th of January. Well, if there's some time between now and the 16th of January where I could just close up this trade and hit the trail with most of that gain and eliminate any risk at that point, maybe I might want to do that. So for some traders, they might decide, well, even if I could get out with 80%, and I'm staying with consistent percentages to what were demonstrated just a couple of hours ago, because putting in the orders for a credit spread are very different for putting in closing orders for a debit spread, which is what I demonstrated 2 hours ago. But let's say that our trader is looking to sell this trade for a credit of $1.25 and to get back out if they've captured, or if they can capture at least 80% of that. What's 80% of $1.25? Actually, I can do the math on that pretty quickly. It's $1. So how much can we pay and still retain $1 here? Well, if we collected $1.25 and then we spent 25 cents to close this trade up, that would leave us with $1 in the portfolio, or $100 per vertical spread. So let's say that's going to be the plan here, exiting with at least 80% of the $1.25. So that's planning for the best case outcome. Sometimes trades just don't work out though. Let's say that we were hoping that we collect that $1.25. We're hoping that it starts to decay in value, moving more towards zero, closer to maybe that 25 cents that we're hoping to exit for. But instead, the stock is misbehaving. And instead of the stock going up or even sideways as we might have hoped, if this starts to fall down, it might get more and more expensive. It might cost us more to get out of this credit spread than we received initially. And if we leave it long enough, it might cost up to $5 to get out. That would be our maximum loss scenario. So instead, maybe our trader has a plan in place. If the trade is going so poorly that at some point it would, we're halfway to our maximum loss on this trade, maybe they just want to get out. Let's say that that's going to be our plan here. Okay, so let's put this plan into practice, because I want to demonstrate how these orders are entered. Pardon me. Okay, but let's go to our trade tab, and I'm going to create an order here to, first of all, enter this vertical spread, and then we're going to attach 2 closing orders. So 215, 220. Let's come up here where it says spread single. Let's change this to a vertical spread. So we can look right here at our 215 and 220, and it looks like our credit, not 215, 220, 215, 215, 220. I was just pointing at the wrong one. It looks like $1.25. We may even be able to get a little bit more than that, but let's just put in an order for $1.25. It might fill for more than that. But here we are with an order queued up. We just click on the bid price to create that order. By default, it's going to put an order, or it's going to create an order to do 10 vertical spreads. Can we afford 10? For the webcast series that I typically teach on Thursdays, just as an example, we'll try to keep the risk under $4,000 total. So if we're able to fill this for $1.25, that would leave us with a risk of $375 per vertical. So $375 on one. If we did 10, that would be $3,750. Actually, that would be within the risk tolerance of this example portfolio that I'm managing. So let's stick with that. Let's do 10 contracts. We're looking for a credit. Let's just stay with what we have been using as our numbers now. You'll notice that's even below the natural. That looks like that has a strong chance of a relatively rapid fill. Still not guaranteed though. Well, let's put in that at $1.25. Now, how do we put in those closing trades? Let's talk about the fun part first. Let's put in an order. And first of all, we have to tell the system that we're going to be adding 2 sell orders or closing orders, not sell orders, closing. Let's use the correct terminology. We're selling to get in. It's actually buying to get back out of these trades. But I'm going to create what's called a first triggers OCO order. What that means is if this first order fills, I want that to trigger 2 closing orders. One to take profits if they emerge, one to take losses if they accrue. So let's do the fun one, the profit one first. They don't have to be done in this order, by the way, but we'll do it this way. So Jeff says, oh yeah, here we go. So I'm going to right click and create an opposite order. This one is going to be the one to take profits. I'll right click again, create a second opposite order to take losses. So this first one is actually going to be a limit order. We're going to make both of these good till canceled. But this limit order, let's put this in for 25 cents. So explicitly, what we're saying here is if we can collect a credit of $1.25, and then if we can exit that trade for just 25 cents, that would be the realization of $1 profit. Now, obviously, we're setting commissions aside, but $1 is 80% of the full $1.25 that we are trying to collect here. So it's exiting with an 80% profit target. Okay? Now, the other one is our stop. And in the case of our stop, we know if we fill for if we fill for $1.25, there's $3.75 of risk. And if we're trying to cut that potential in half, that's going to be about about $1, what is that, about $1.85 or $1.90. Let's put in our stop, $1.85. Here's the math on this, just to help you follow along, because I know this first one's pretty straightforward. Buying out for basically 20% of the original credit collected. That's what that is. The second one, though, this is the plan for the stop order. I'll throw in the word for here. Plan for the stop order. So how do we calculate this? Well, if we're in for $1.25, but we don't want to risk more than $1.85, where's our stop going to be? It's going to be about $3.10. In other words, this is how much we can afford this. We don't want this to happen, but it might. So if these contracts, if this vertical spread is growing instead of shrinking in value, it's going the wrong direction, and it forces us ultimately to buy out for $3.10, well, that would be $1.85 more than we received as an original credit, and we'd have a loss. But it's not $5. Notice we could lose $5. How much more loss would that be? That'd be another $1.90. So we're cutting it off about halfway between $1.25 of the, that's the credit received, and the $5 maximum loss scenario. So that's it, $3.10. That's what we're going to put in for our stop. If you need to go back to the archive for this webcast and rewatch that, so you can see that the math behind that again, that's one of the great benefits of our archives. But let's put on our stop at $3.10. So yes, it is at a price higher than the price we originally are looking to receive. So there we go. There's our trade. Let's click confirm and send. We're looking to sell these 10 verticals for a $1.25 limit. If we can get out for 25 cents and realize gains, great. On the other hand, if it's going up in price instead of down, well, we have a stop in at 310. As with other types of stops, that 310 is not a guarantee that we will exit at a specific price. So that's just a trigger point. It's possible that, if the stock is moving sharply downward, just going in the wrong direction, we might have to pay more than 310. So the 310 is triggered, sends off a market order, and we might have to fill it. Could be 315, 320, 330, could be more than that. Okay. So Roger says, if we collect a premium of $1.25, and should we exit when we have a loss of $1.25? Okay, so Roger, so that's a different potential. So Roger is saying, well, for some traders, maybe they want to set their loss potential at just twice what their premium was. That's a different approach. It can be used. So what would we do here? Well, instead of putting in our stop at 310, which is actually halfway to maximum loss, in this case, we might put in our stop in at 250, which it's not going to be even halfway to our maximum loss, but it is going to be double the premium received. It's just different logic. Roger says, are these stop limit orders? Nope, they're not stop limit orders. This is a limit order, and then entirely separately, a stop order. But there is a condition between the two. If one of them is filled, the other one's going to be canceled. That's the way a one cancels other OCO order works. There we go. Good question. What else did I miss? Let's see. Okay, Andy says, isn't the stop built in because the spread limits the loss? The swings in the stock will quite often kick one out. That's another good point here, Andy. When we use a stop, what we're saying is we're not going to tolerate a move of quite as big a distance. So is it possible our stock moves just enough to stop out our trade and then recovers before expiration, puts us right back to where we might have hoped to be, and we're back up there at maximum theoretical gain? Yes, this does actually change the probability scenarios of the trade. So what we're doing here is we're accepting a trade-off. We're exposing ourselves to a greater likelihood that we could just get whipsawed out of this trade, but hopefully the advantage there is that we're not exposing ourselves to as much net loss potential. Now, if we want to look at the spread itself acting as a stop, I think that's a fair way to look at things. Yeah, there is a theoretical maximum loss here. $5 minus the credit received, $3.75. And if the trader is okay with that loss potential, maybe they don't use a stop. That's okay. You will commonly see me trade just exactly that way in my demonstrations. But I just get questions all the time. How do I put in stop orders if I want one? So that's what I wanted to talk about today. How do I put in limit orders if I want to have a target that's short of maximum gain? So that's what we're talking about. Good questions. All right. So Jeff says, when it says market order, can we use the underlying price? Yes, we can. That's another thing that could be done. I'm not demonstrating that in this webcast, but yes, options, entries, and exits can be tied to stock price performance rather than option price performance. There are pros and cons to that. Let me just kind of throw that out there. But yeah, we're demonstrating it based on option price today. What else? What other questions do we have? Anyway, let me send this order off while we're talking. So there are commissions to be paid to get into and potentially out of this trade. So $13, that's 65 cents per contract on 20 total contracts, the ones that we're selling and the ones that we're buying to get into the verticals, and then another $13 to get back out if we get to that. Well, let's send that order off and see if we can get a fill. I talked for so long. Let's see. $1.25. Yeah, it still looks like we're in that range. That's just the bid price right now. So I think that's pretty likely to fill, and there it is. Sold into that vertical spread. And we have a plan in place for the management of potential profits or potential losses. Let me go back to the chats here and see if we've missed anything. Roger says it's a 300% loss then if we go from $1.25 to 375? You bet. Yeah. In this trade, the way that we've constructed it, there's a risk potential of $3 for every $1 of potential reward. Why in the world? I gotta ask this question. Why in the world would a trader ever take a trade where they stand to make less than they stand to lose? Well, it's because the probabilities are actually strongly in the favor of this trade working out. So that's the trade-off, as I discussed earlier, with vertical spreads, for credit spreads and for debit spreads. As the probability of success goes up, the reward for being successful goes down. What I would love for somebody to show me, and I've been doing this for many, many years, is a vertical spread trade that delivers a high probability of success and also a larger reward than risk. It doesn't exist, not in my 20 years of experience. So yeah, that's it, Cecil. Yeah, exactly right. It's a probability reward trade-off. And so for some traders, could we just reverse that scenario? Maybe there's a trader that likes to see higher reward than risk. Great. We can just take a lower probability trade and it will deliver that. So good questions, everybody, but we've actually accomplished what I set out to do today. I wanted to talk through the logic of a credit spread plan that includes not just when to get into the trade, but how a trader might manage the back end of the trade, planning for profits or for losses, and then putting that plan into action through the submission of orders for targets and stops. All right, Two Continents, One Island says, why not just set the trade such that when you lose the credit received, you get out of the trade? We could. So that can be done, but the question is, why not do it? Well, the trader might choose to do it. I'm not going to make an argument they should or should not, but an argument against doing that is that the volatility of the stock could cause the stock to just wiggle down temporarily in the next 29 days and cause that loss, kick the trader out, and then the stock just continues on its merry way, having already left us in the dust. So yeah, using comparatively tight stops on options trades, on vertical spreads and so on, can expose us to a higher probability of an unprofitable exit. That's it. So it limits the loss potential theoretically. Any kind of a stop isn't a guarantee that we know exactly what our loss potential is going to be. But we're limiting the downside, but increasing the probability of incurring that downside. That's it. Okay, so what else do we have? If we place a credit spread, then decide to enter the exit trades later on, how do we do that? Good question, Roger, and I have the time, so let's do it. So let's go to our Amazon trade. There it is, right there. So here are our orders. I'm going to cancel it. I'm going to cancel the OCO group. Okay. There we go. So now we have our vertical, but we don't have those trades in. So here's how we might place that order. So let's say that we have our plan in place, same 80%, 50%. What we do is come to the monitor tab, go to the existing position and right click on it and create a closing order. Now, I'm going to choose to buy. This is going to be one of our closing transactions. Let's let this be the limit. So we'll call that 25 cents. Then to add the other one, we're just going to make this an OCO order. It doesn't need to be first triggers OCO because the original order already triggered. Now we just need the OCO. So here's our closing transaction for best case outcome, or not best case, just for the profit. So I'm going to right click on that and create a duplicate order for our stop. And we'll just make that 310. There we go. Confirm and send. Putting in an order to buy for 25 cents or less, or buy at a stop of 310. Now there's still commissions to be paid if these orders are executed. Let's send this order off and the trade's in place. So that's good, guys. I hope this has been helpful for you. I do like that you asked that question about putting it in after the fact, because that's another one that comes up from time to time. And I don't always remember to do that. I don't always have the luxury of time to demonstrate it, but we got it squeezed in here today. Everybody, hope you don't mind me being the interloper today. I was just filling in. You're certainly invited to join me if you'd like to see my regular webcast series. I do one on long verticals and diagonals on Thursdays. So same day, just a little bit earlier in the day. You're invited to join me there. I have other webcasts all throughout the week, as long as the markets are open, as long as I'm not on vacation. I'm here delivering at least one webcast a day. So join me there. But a couple of other resources to be aware of as I let you go. First of all, make sure, if you haven't done it already, to subscribe to our YouTube channel. It's called Trader Talks Schwab Coaching Webcast, but our channel is where you can join the live streams. You can find the playlist for previous webcasts. You can even do searches for topics of specific interest and look through our archives. Now, another thing that James and I would suggest you do is to follow your favorite Schwab presenters on social media. You can follow James and me. Well, you can find James on X. You can find both of us on X. Find James there at James Boyd CS. You can find me on X at Cameron May CS. But this is where I'm actually very active. I posted 6,300 times on X. But if you reply to one of my posts, I try to reply right back to you, and it allows for communication when the cameras aren't on. Now, as of just maybe 6 weeks ago or so, you can also follow me on LinkedIn. Just go to linkedin.com/in and then go to Cameron May CS. So linkedin.com/in/Cameron May CS. That'll take you to my profile. Give me a quick follow. And if you reply to one of my posts here on LinkedIn, I try to reply to you as well. All right. Everybody, thanks for giving me your time today. I will see you in a future webcast. Thanks to everyone who's already clicked the thumbs up button. I'm just also scrolling through and making sure I didn't miss a survey, and nope, I didn't. So, but if you click the thumbs up button, if you enjoy one of our webcasts, you like it, make sure that you click that like button, because it's an applause. It's kind of like a pat on the back to your presenter, but it also gives us a boost in the YouTube algorithm, helps more people find these webcasts. So definitely helpful, definitely appreciate it. Doesn't cost anything, only takes a second to do it. James, thanks for helping out in chat. Everybody, I'll see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.